This demonstration is designed to instruct you on using MetaStock software and accompanying plugins. It is not a recommendation to buy or sell exchange-traded instruments, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented should only be used by investors who are aware of the risk inherent in trading. Thomson Reuters shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company.
I want to introduce to you today a speaker. He's giving his inaugural MetaStock presentation today, and so I'd like to have you help me join me in giving him a very, very warm welcome. Greg is somebody that works very, very close to our office in Salt Lake City. He's been in the market for a number of years. He does a really good job of teaching people how to trade options and how to manage risk with their options. And I'm really, really curious to see what he's got to say to us tonight. So without further ado, I'm going to turn the time over and let him get to teaching.
Perfect. Thank you, Jeff. Give me a little bit heads up that you guys can hear me okay. Is my audio coming across loud and clear? If you can just type it in the chat section. Okay, perfect. Thank you, Tom. Glad to be here with MetaStock. MetaStock is a fantastic product. I know you guys already know that as being part of the user of this. What I hope to do today, and before I get started, I also have to keep my regulator happy. I am a registered investment advisor with the state of Utah, and so anything in this presentation, I have to remind everyone, is for educational and illustrative purposes only. I'm not giving you any trade recommendation or any type of trade advice today. So remember, the options market does involve some risk, so make sure you have an understanding of the rights, risks, and obligations associated with the options instruments before considering placing any types of trade. The market is rather tricky. In fact, my guess is, one of the things that you guys are doing here, there's a number of reasons why individuals educate themselves in the market. It might be to try to learn how to make money in any market, not just the market. I call it the monkey in a suit market. You just throw a dart at a copy of the Wall Street Journal and pick a stock. It was kind of like how it's been, well, maybe for the 9 months previous to a couple of months ago. The recovery off the lows that we hit, similar to what we had in the late 90s. Those were just bullish markets and easy, and I think people got complacent and felt they were brilliant in how easy it was to make money. But obviously, as you know, if you've been in the market for any amount of time, you know that it does take more than just a little bit of luck at picking the right stock to make money in any market. Possibly you're here to be because you're sick of losing money, because you're sick of stop losses, particularly and I hope to show you how to adjust trades today, particularly with the use of options. The other thing that you may be looking at doing is learning how to preserve and protect capital. Ultimately, I think it all comes down to, we all have the same goal as individual investors who have taken control of our portfolios, is that we're really trying to build financial freedom, and that financial freedom is different for every one of us. Before I get into my systematic process of how I trade, let me just take a brief step back and look at 2008. And the reason I want to specifically bring up 2008 is this is one of those times where it wasn't just a monkey in a suit market. 2008 was very difficult. In fact, most individual investors lost money in 2008. And I'm not going to have you guys raise your hand as to who made money and who lost money in 2008. If you made money, fantastic. You're one of the few. I think most people experienced returns somewhere in the neighborhood of this. This is pulled from Lipper. And it didn't matter what sector you were in. If you were just a buy and hold investor throughout 2008, you lost money in biotech, in technology, in financial, in real estate, telecom, gold, oil. Everything went down in 2008. Now, oftentimes we're preached to by our investment advisors of the world, guys like me, that the way to control risk in the market is through diversification, right? I think Kramer's got a spot on his show called Am I Diversified? something like that, where you go through and he tells you whether you're diversified across industry. And although I agree that diversification is a good thing in bullish markets and a good thing in maybe even sideways moving markets, because it takes the risk out of maybe a company like Enron imploding and destroying my whole portfolio if I had all of my eggs in one basket, so to speak, with Enron. That diversification across multiple stocks helps me. But when the whole market goes down, there's really very little you can do to control risk through diversification. However, there are tools you can use, and I hope to show you some of those today, because 2008, yes, it was painful. I think most of you in the room would agree with me that there's going to be more of that in the future. We'll have ups, and we're going to have more crashes as well. David Bach, you may recognize this gentleman, stated that financial education needs to become part of our national curriculum and scoring system, so it's not just rich kids that learn about money, it's all of us. Now, I agree 100% with this. However, for you and I, my guess is that most of you in this room are well through the national curriculum of your education. You're not in organized school anymore, so you're reaching out and you're taking classes like this. And I applaud every one of you for educating yourself about how to control your finances, and in particular how to invest in the market and do it effectively. Now, I wanted to bring in this snapshot, and the reason why I like this one specifically, this is taken from almost a year ago. May 5th, I believe, was the day, to be exact, or May 6th. I don't remember which day it was. I believe it was May 6th. That was lovingly referred to by many people as the flash crash. Now, this was a headline news that I just pulled off Yahoo Finance. Dow paring losses after plunging almost 1,000 points. Wall Street hammered amid European debt worries. Now, the reason why I like this quote and why I brought this in from Yahoo Finance is it shows how quickly the market was moving. And the way it's got two different quotes here on the same screen. It's got a delayed quote, a 15-minute delayed quote, and then a real-time quote. As you can see there, kind of in the middle of the screen, the bottom red number, the 15-minute delayed quote, it's showing that Apple was down $9. The real-time quote, so 15 minutes later, the stock is down $45. And in fact, it ended up going another $11 or almost $12 lower than that, hitting about 198 intraday before it bounced back up and finished a little bit higher. But what most people did this day, if they were watching the market, and some of you guys may remember this market a year ago, is they watched their positions all get stopped out. If they had bullish positions with stop losses in place, those stop losses got filled and they saw themselves lose money. In fact, there's been a lot of studies saying that a lot of the flash crash was actually a lot of retail investors who had stop losses on ETFs. And that was some of what propelled it lower. Regardless of what it was, whether you had a stop and got filled or not, or whether you just panicked this day, a lot of people sold out of the market that day only to watch the market turn back around and run back to the upside and have a phenomenal year last year, but this panicked them out. Now, I can tell you I had a trade on this day. For those of you who have traded options before, you'll know what a bull put is. Some of you may or may not know what that is. I had a 240, 230 bull put. Essentially what it is, for those of you who haven't traded options before, it was a bullish options trade that needed the stock to stay above 240 for it to work. Now, it was in the current month, and as you can see, the real-time quote there, stock's trading at 210. Now, if I would have had a stop loss as my means of protection, I would have stopped out of that trade. I lost my maximum, well, whatever I would have set as my stop. Or if I just would have panicked out of the trade, it may have been even worse. I may have lost 50% or 80% on the trade. I didn't close out of my trade that day because I had a plan. I had a systematic approach as to what I was going to do if the stock finished lower. Now, I didn't know it was going to bounce back, which it did, and my trade actually worked my maximum profit eventually on this bull put that I was looking at. But I didn't panic out because I had my plan in place. And that's what I hope to show you guys today is what this plan is. There's a lot of places where individual investors make mistakes. And as good as our intentions are, as individuals who take our money back into our control, we have good intentions, but what it comes down to is we really don't have, I believe, a practical knowledge or an applied knowledge of how to do that. Because there's a lot of places to make mistakes when you're beginning in investing. Whether it's, you're relying on initial expectations too much, whether you're making gut calls on the market, whether you have a poor understanding of fundamentals or market sentiment, whether you're using great strategies at wrong times. A good example of this is a great strategy, an option strategy that I use regularly is a trade called an iron condor. Now, some of you may be familiar with an iron condor, some of you may not. But it's a good strategy during certain times. But certain times it's an awful strategy. Let's see if I can make a change real quick. I'm not sure. Let's do this and disable. Hopefully that takes care of your echo, Jennifer. Okay, good. So back to my conversation about iron condors. Iron condors are a phenomenal strategy given the certain market condition. However, in situations like October of 2008, they were absolutely destructive to people's portfolios. And if you didn't have a plan in place to say, what do I do if the trade goes wrong? Well, then people, got themselves burnt with doing those types of credit trades that, again, are good trades, but applied at the wrong time can absolutely hurt. Like I said, ultimately, I believe what this all comes down to is a lack of applied knowledge of how to take all of this stuff you've learned in books and in webinars like this and how to put it into real life education and real life trading. So for me, this is a systematic approach. Now let me relate this to the game of golf, and I won't elaborate on this too much so I can make sure and get through all my content today, but I like to golf. I'm not a great golfer, but we just had the Masters this last weekend. It was, fun to watch Tiger make a little bit of a run, but then it was fun to see a young kid win it and, pass on that green jacket to the new youth of the world. But, the game of golf is a fun sport. Now, for those of you who know how to play golf or familiar with it, you know that it's going to be very difficult for someone to golf if they're only approaching the game with two clubs. Maybe a driver and a putter. If you hit the ball in the sand, it's going to be very difficult to get it out with one of those two clubs. If you hit the ball in the long grass, the rough, again, a very difficult challenge that you're going to have to hit it out with only two clubs. And for every single situation on the golf course, there is a club designed for that situation. Investing is no different, in my opinion. However, way too many people rely on just one or two tools to trade the market. They're either long stock or they're short stock. Or they maybe do covered calls, and that's their only tool for approaching the market. And the reality is the market can throw a whole myriad of different scenarios at you that you as an individual investor need to be able to react with. So it's important that you have the right set of clubs for the specific situation that the market might give you. So, I know I've got a mixed crowd today. I know some of you have never traded options. You may be a stock person. Some of you may trade options quite regularly. For those of you who have traded options before, I'm going to ask for your patience here for the next 5 minutes or so as I try to get everyone briefly up to speed on what an option is, so that we can hopefully talk the same language here in just a minute. So, inside of options, you really have two different types. You have chocolate and you have vanilla. Oh wait, no, that's ice cream. Which one's better? It depends on the mood, right? Sometimes I'm in the mood for chocolate, sometimes I'm in the mood for vanilla. Well, there are two types of options as well. You've got a call option, which is the right to buy stock at a set price within a set time frame. You also have a put option, which is the right to sell stock at a set price within a set time frame. Now typically you can either be long each one of those options, so you can be long a call or long a put, or you can also be short one of those two options. So you can be short a call or short a put. Now what I mean by being long or being short, for those of you who aren't maybe familiar with those two words, just replace buy and sell. So either I'm buying calls or I'm selling calls, or I'm buying puts or I'm selling puts. Now call options, like I said, the right to buy an equity at a fixed price within a set time frame. The expectation is that the equity, the underlying stock, is going to go up in value. And as the stock goes up in value, and I get the bullish trend, I am going to make money as the stock trends higher. Now this is a debit trade. In other words, it's going to cost me money to put this trade on. Short call options are simply the other side of that trade. Now instead of having the right to buy, I've sold my rights away. So someone else has the right to do something to me. Now in case of this situation, they have the right to take my stock from me. I'm giving them the right to buy my stock away from me. Now I'm getting paid for that. This is a credit trade. Generally I sell calls when the expectation is that the stock is going to either decrease in value or maybe just go sideways. And if I do get that bearish trend, I am going to make money on this trade. And again, this is a credit trade. Now the maximum amount of money I can make on any type of option, if I'm selling it, is the amount by which I'm selling it. Same thing is true on the put side. I can either be long or short. The difference now is I'm having the expectation or the right to sell instead of the right to buy. So if I think the stock is going to go down in value, I can go buy a long put, and as the stock does go down in value, my trade is going to go up in value or gain more profit. And then short puts are simply selling that option to someone. So now I have an obligation to buy a stock at a set price. And again, this is a credit trade. Now, for those of you who are relatively new to options and that just felt like a lot of foreign language, don't worry. It always does at first. But I will tell you, these instruments will change the way you trade. And the way you combine them with stock positions will allow you to take a position in the market that you don't care where the market goes. Let me show you. I'll show you this trade adjustment idea here just momentarily. Let me talk about where options get their bad name. And in some cases their good name, but this is where they get their risk. And one of the biggest reasons why people trade options is for leverage. It allows me to go buy a stock or control a certain amount of stock, but not have to put up all of the money that it would take to actually buy the underlying. I'll give you an example. Dennis Eckersley, Rachel Wise, and Jay-Z. Not a very likely combination, right? But they go out and they create a company together, right? Again, this is a theoretical example. They didn't really do this, but let's just assume they did. I've got the Eck, I've got Rachel Wise, and I've got Jay-Z. In other words, I've got XYZ company, and let's trading at $50 a share. Now, I can go in and I can also buy at the same time a call option for 1 month out, and that's going to be selling for $2 a share. So if I bought the stock, let's say I go buy 100 shares of XYZ for $5,000. The stock goes to $55 a share. That's a 10% return on investment, right? Pretty easy math. Stock goes up $5. I put in, $5,000 or $50 to start with. I'm up $500 or a 10% return on investment. This call option is also going to go up in value. Now, instead of having to spend the $5,000 to control the 100 shares, I'm only having to spend $2 or $200 for that one contract. Now, when the stock goes up to 55, I have the right to exercise my call. In other words, buy the stock Remember, that's what the right is. I'm buying it for 50, and I can turn around in the market and sell the stock for 55. So I'm going to make $5 on my stock transaction, and I spent $2 to have the right to do so. So I'm going to make the difference. I make $3 a share. Or in other words, I'm making $3 of profit on a $2 investment, or $150 or 150% return on investment. Again, this is the allure of options. This is what makes them exciting. Now, what's the problem with leverage? Well, that leverage cuts both ways. In other words, yeah, it's great if I'm right. It's awful if I'm wrong. So that's, again, where options are both alluring, because you can get huge returns. You can trade with, you can start with very little amount of money and make a lot of money, but you've got to be cautious and understand truly what you're trading. I've kind of broken it down as far as options trading into a hierarchy of understanding. You know, number one of hierarchy of trading is you just buy and sell stocks only. You don't trade options. Number two is maybe you trade stock and maybe one option at a time. Again, maybe you're buying a long call alongside your stock. Maybe you're doing covered calls. Maybe you're doing a married put strategy. Those are maybe number two. Level three is maybe you're starting to understand how to do some spreads. Recognize you can do some things like butterflies and iron condors and credit trades, maybe diagonals, calendars. A lot of, again, you can, there's a whole myriad of ways you can structure trades. And lastly, once you learn how to adjust losing trades into profitable trades, I believe you've reached the pinnacle of trading. As I mentioned, here's my 6 steps for success. And I'm not going to, unfortunately, in an hour class tonight, I don't have the bandwidth nor the time to fully give each one of these their due diligence. In fact, we've created a whole education over at OptionsANIMAL to teach this process of how to trade that is broken down into 8 different levels and 55 some odd different classes of teaching you all the different nuances of this. But in a nutshell, this is the 6-step process on how to trade. Step 1 is to determine direction. Now this is where MetaStock helps you, particularly in this trading process. This is where you're going to gaze into your crystal ball and you're going to determine where a stock is going. Now, of course, it's a little easier than that, because it's not just gazing into a crystal ball. Let me give you some tips for being more proficient in this first step. First one is don't cheat. Just because Kramer likes a stock doesn't mean it's a solid fundamental stock. Use the tools that are available to you. Things like fundamental report cards. Technical analysis particularly can help you become more accurate, not only with trade entry, but also trade adjustments. You know, become proficient in the use of your charts. There are a phenomenal amount of tools available through MetaStock that help you determine buy signals and sell signals. Now, which one is the best? Well, it depends. I know, again, we have a whole community of active option traders over at OptionsANIMAL, and several people use different indicators to determine what trades they want to use. Some people like to use Bollinger Bands. Some people like to use the MACD. Some people like to use different type of exponential moving average crossovers. I particularly like 3 combination signals at the same time, and these are the ones that I'm going to work with MetaStock in creating an indicator that's specifically for OptionsANIMAL that combines 3 of them. It combines for me the MACD. I look for crossovers in the MACD. It combines the RSI line crossing through 50. RSI is the relative strength index. And then it combines a combination of the 5 and 20 exponential moving averages. And when all 3 of those cross and give me signals at the same time, I'm very confident then in the trend. Now, does it mean I'm 100% confident? No. There is not a 100% accurate indicator. If there was, it would just be a money machine, right? That's the beauty of the markets, is that there will never be a 100% accurate indicator because we're people. There's a people component that can create other situations. And what's imperative, in my opinion, is you don't just rely on any one tool. Don't just be a fundamental long-term investor. Don't just look at charts, but don't ignore either one of them either. I feel it's very important that you look at all three things. You look at fundamentals, you look at technicals, you look at market sentiment. Because sometimes the chart will be telling you one thing, the fundamentals look great, but a black swan event occurs and causes the market to panic, and it doesn't matter what the chart was just saying or what the fundamentals of Apple might be, the stock is going down because the market is in panic mode. So it's imperative to combine all three of these. We do this regularly in what we call animal trades, and we show our students how we're trading. Okay, next step in the process to analyze the trade possibilities. Like I said, there are a whole slew of different trades you can use to take advantage of different trends. If you're the type of trader who likes to find stocks that are trading in a range and staying inside of bands, again, you use Bollinger Bands primarily, there are trades that you can structure outside of those Bollinger Bands. Things like iron condors, things like bull puts. If you like to find trending stocks and look for momentum indicators, well, then there are things like bull puts. There are things like bull calls, diagonals. What I would tell to you again is look for the trade that fits the trend. Don't fall in love with just one type of trade. Just because I like call calendars as an example doesn't mean I can place that trade in every trend. Same idea is that, you know, every tool is a hammer, right? Except a screwdriver. When you try to use a screwdriver as a hammer, it's what? It's a chisel. So make sure you're using the trade properly. Well, what trade is best? Well, again, here's where you've got tools. This is an example of some snapshots from your different brokerage firms that give you tools to help you create different trades that fit the trend that the stock might be in. Step 3 is relative, kind of I kind of went through that briefly already with selecting and structuring that strategy. Proper structure is also important. Determining exit points in step 4, I think, is where most people fail. You know, they jump into a trade and just think, I'm going to see how much money I can make. I'm going to, you know, or I'm going to, who knows where it's going. I'm going to let it run, right? And they don't define their exits. This is critical. Controlling the emotions of greed and fear is critical in long-term successful investing. You may put on a few trades, luckily, if you're allowing yourself to make decisions on emotion, but everyone who I know who invests emotionally does not last very long. You've got to become very systematic, and again, that's another reason why you need to get comfortable with the MetaStock platform, to be able to help you become systematic in your decisions. When a signal hits, execute on the signal. Execute the trade. Mr. Buffett said, only when you combine sound intellect with emotional discipline will you get rational behavior. Rational behavior is imperative for us as individual investors because at times the market can be very irrational. Okay, back to the systematic approach. Step 5 is pretty simple. It's you know, placing the trade. Now I know there's a lot of, I don't want to make it sound like it's not an important step. Step 5 is important. You know, recognize there are times when you need to use the bid-ask spread. And there are times when you can use market orders and times when you can't use market orders. Let me give you an example. In October of 2008, I saw the writing on the wall. You know, I was buying puts on the SPY, which is of course the ETF for the S&P 500. For those of you who aren't familiar with the SPY, ticker symbol SPY. So I was buying puts on SPY in anticipation of the bearish trend that was coming with all of the foreclosures that were going on. Now the big trading houses were still alive, and you know, had I foreseen the crumble of Lehman and Bear Stearns, I would have been buying puts on those and not puts on the SPY. But you know, I didn't have that insight yet, and so I was just buying protection on the overall market. So I had at the money puts on the SPY the day before. I bought them about a week before what I call Lehman Day. You know, you guys remember the day, if you were trading a couple years ago, the day that Lehman came out and announced bankruptcy. That it was the same day that Merrill Lynch was acquired by Bank of America. AIG was essentially saying we're going belly up. We need all, you know, uber $1 billion to stay afloat. So you would expect that my puts, remember what puts are? Puts are the right to sell stock. And I had puts on the SPY. I had bought them for like $4 a share. Now, my puts, when I opened up my account that morning, because again, the Dow's down like 600 that morning. The NASDAQ's down like 120. The S&P's down like 70 points. It was an ugly, ugly day. You'd think I would have made a lot of money on my puts, right? They were, when I went to go sell them, the bid and ask price, remember I bought them for about $4. The bid and ask price, the bid was $1.20, the ask was $12. Yeah, I know. not cool, right? You know, again, I had an option that I had bought for $4 that if I just would have gone in and put in a market order to sell it, I'm going to get filled around $1, even though the market was getting creamed. So it's important to know when. Now, I did make money on that option, by the way. I didn't take the market order, and the market did tighten up just a little bit about 30 minutes after the market opened, so I didn't get filled on those market orders. And I used a limit order, however, to get filled on my trade, and I made, you know, I think I sold them for around $7. I don't remember exactly what it was I sold them for. I made a nice little return. Wasn't quite 100% return that I made on those options. The point being is, yes, it's an easy step in step 5, but there are times when you need to know the difference between a limit order and a market order and when to use each one. Okay, this last step is really what separates us from the rest of the education world and the rest of the trading world, in my opinion. In fact, I was teaching a class like this once for Trade Monster, which is a brokerage firm based out of Chicago, run by Pete and John Najarian. Some of you might be familiar with those guys on Fast Money. Anyhow, I was doing a webinar like this for them, and I had one of my students from OptionsANIMAL actually in the webinar, and he made the comment while I was teaching this class that step 6 is what I really learned from OptionsANIMAL. That made the difference of me, you know, I'd learned steps 1 through 5 before. What I hadn't learned was step 6, and that is to adjust a trade and flow with the market. See, the market is a dynamic, living, breathing instrument. It changes from day to day. And too many people, I believe, approach the market with a very static view of the market. They think, I'm going to go trade the market. I'm going to go trade it bullishly. And if it's bullish, great, I make money. But if it's bearish, okay, I'm out. And I'm going to stop out and I'm going to go look for something that's trading bullish. But what you can do if you understand options clearly and fully, which is what we help you how to do, if you understand that, you can actually trade the market regardless of what direction it's heading in. And you adjust and morph as the market moves. Let me give you an example of this. This is a chart of Netflix. Now, some of you may cringe with the word Netflix, right? I love Netflix. Not just I'm a Netflix subscriber. I watch it from time to time. You know, my kids love it. I probably have it as much for that for anything. Watch a lot of cartoons on Netflix, but you know, my wife and I will watch some stuff from time to time. Point being is that it's really popular. And of course, it's been a very, very popular stock on Wall Street for the last couple of years. In fact, in the last year, in fact, even in this chart that I pulled in from September through March 14th, just a month ago, this stock had gone from about $150 a share as high as $250 a share. Now, there's a lot of reasons why Netflix had its huge move. I mean, they had a phenomenal earnings report. And after their earnings, that's what this gap was here in about mid to the end of January. This gap caused the stock to shoot higher. Now, I was looking at Netflix going, I actually sold on that big up move because I had had a very nice profit, and I'm thinking to myself, okay, I'm going to jump back in, or at least I'm going to look at trading Netflix if I get a little bit of a pullback. Now, some of the things that I was looking of some concerns about Netflix and thinking, maybe I ought to start trading it bearishly, first of all was they were traded in an 80 plus PE, or price to earnings ratio. Very expensive, very highly leveraged company. So I'm thinking, okay, my next trade is probably going to be bearish. Now, I didn't want to execute it at a 52-week high. Anyone who tries to do bearish trades when things are at 52-week highs is a lot braver than I am. But I wanted to wait for a couple of other signals. Well, I started to get a few. First of all, I had 3 big down days in a row. Now, these 3 big down days, if you follow Netflix, you may know what caused this. Some of you may not, but if you weren't following it, what happened here is you had the entrance of Facebook as a potential competitor. Now, we had heard Amazon was going to compete with them, and Coinstar and a couple others before, and Netflix had just shrugged it off. Why? Because I don't think they were really legitimate competitors. Not that Amazon isn't a legitimate company, but people don't go to Amazon to be entertained. They go to Amazon to shop. Facebook, on the other hand, people go there to be entertained. So and they've got a lot of people that go there to be entertained. So this is, I think, the first legitimate competitor that's thrown their hat in the ring into Netflix's business model that has a lot of margin. So the stock reacted bearishly. I think this was just sentiment. I mean, it wasn't that Netflix came out and said we're worried about this, or that we're having to lower our guidance on our earnings because of this. It was just market sentiment. However, as you know, market sentiment can cause some trading signals that cause you to potentially want to go bearish. Now, I still wasn't bearish enough yet because I saw a level of support. The 50-day moving average was holding. Now, it finally broke, and I was getting ready to go on my bearish trade yet. Now, I'm still not the guy that likes to trade right when the signal occurs. I don't like to start the wave. I like to ride the wave. But we had a couple of events happen. First of all, we had an event happen on, I believe it was March 6th was the day. Some of you may remember what happened that day. We had the United Nations come out and say we are going to install or place in a no-fly zone over Libya, which is another way of saying we're going to war against Libya. The European Union was tired of letting their oil get attacked, so they were going in to defend their oil. Now, that caused the market to start to get very bearish. In fact, we got a nice correction in the market that started those few days. So it's about getting ready for my bearish trade. I'm not quite there yet. Now, Netflix had a couple of positive days and actually bounced back up and hit resistance. In fact, when it bounced back up and hit that 50-day moving average, I was just waiting. If resistance held, I was going to enter my bearish trade. And then I got the second black swan. And in my opinion, the market did not react big enough the first day. What was the second black swan? The earthquake and the ensuing tsunami that, of course, caused all the devastation in Japan. And again, like I say, the first day, the market did not react bearish enough. So what I thought to myself, again, this is my thought process as I'm getting ready to place my bearish trade. This is all my due diligence, essentially, that I'm sharing with you. My thoughts are, the market's going to crash. We're going to have a nice bearish correction, so I'm going to go buy puts. Again, remember, for those of you who aren't new or who are relatively new to options, the put is a long put option that's giving me the right to sell the stock, so it's going to go up in value as the stock goes down in value. So I'm going to go buy puts on Netflix here with the idea that as the market drops, I'm going to make money. So I'm going to do it on the most volatile stock in the market at the time because I think it's going to move the most. It's got the highest beta. It should move the most, right? So what did I do? Here's my trade. Here's my trade confirmation. On March 9th, I bought 5 contracts of the April 195 put. Now I spent $14.54 on them. So I put $7,200, almost $7,300 into this trade. $7,275.07 after commissions. So Stock's supposed to go down, right? Because the market the next day got crushed. You guys all know that. You've been watching the market for the last month. The Dow was down 250, the NASDAQ was down 60, the S&P was down like 30 that next day. Netflix should have dropped, right? Well, look what it did. Netflix, on the day the Dow was down 250, was up 17. I was absolutely dead wrong on my trade. Yeah, somebody came out with a study about streaming videos on the same day, and it showed that 60% of all streaming movies, streaming media, is on Netflix. In other words, this market that everyone says is the future of media, this digital media space, Netflix owns a 60% market share of that. Pretty good announcement, right? In fact, Goldman Sachs came out and upgraded them on the news. So my put that I bought the day before for $14.54 or whatever it was is worth $4 the next day. I'm down 10 bucks. I'm down $5,000 in one day on a trade that, again, the market's getting killed that day. I was right. I just happened to pick a stock that I was dead wrong on. Now, again, most people, if they had a stop loss in place, got stopped out at whatever it was, 50%, 20%, 25%. Maybe if they didn't have any type of exit plan in place, they're still hanging on to this option. You know, the right to sell the stock at 195, that's now worth $4 the very next day. What I did instead is I saw that the market obviously was going to change. The fact that Netflix was up on such a bearish day, on such a good piece of news, said, okay, the stock's going to run bullish again. So I changed my trade. And instead of trading out of it, I simply added some more trades to it. I created a ratio spread where I sold 10 contracts of the April 210 puts, bringing in a $9,294 credit that allowed me now to have a $2,000 credit on this trade. Now, I was in it for a little while. Either I needed the stock to move relatively bullish or I needed to stay above 210. Again, at the time, the stock's trading at about 220. So I'm still a ways out of the money. But if it does so, I'm going to make about $2,000. And what did it do? Well, it went on its bullish trend. We know where it's at. This chart, I believe, was from March 29th, so a couple weeks ago. Now, Netflix has since topped out and looks like it's running into resistance again. And I may be looking at another potential bearish trade on Netflix here shortly, if I'm brave enough to buy puts on Netflix. You know, the good thing is I am, because I understand this adjustment process. I know that the market reacts. Again, what did I do? Well, the stock ran up. Why did I decide? No, what I did here is I'm going to actually show you that I closed the trade. The reason why I closed the trade is right there on the chart as well. I'm back there at resistance. Being able to read your charts and being able to identify levels of resistance and levels of support is really one of the critical things of being able to successfully enter trades, but more importantly, in my opinion, is to successfully adjust trades that you're wrong on. Because the best of traders is going to be wrong from time to time. And how much different is your portfolio going to look if you can learn how to take those losers? You know, you have 5 or 6 good trades in a row, and then you have that one loser that wipes out the profits from the previous 5 or 6. I can virtually feel you shaking your head because I know you've been there. I used to be there. When I figured out how to adjust a trade and how to morph with the market and change as the market flows, completely changed the way I trade. So we went up and hit resistance again, and I said, okay, it's time to close the trade. So this was my original trade I had put on, and there's my trade confirmation of closing it back out. I closed my 210 short puts for $1.39. Sold my 195 long put for 40 cents. I netted $800 on the trade. Now, it doesn't seem like a huge return, and it's not. You know, it's about a 10% ROI. But for me, it's a trade that I absolutely messed up on, and instead of giving up on the trade, I morphed it, I changed it, and turned it into a new trade. When you have that mind shift, I'm telling you, it's going to change the way you invest. It's going to change the way you trade, and you'll be able to sleep at night. You'll be able to go through earnings events that are happening to Google right now. You know, Google's getting killed in after hours because they missed earnings. Last check, the last quote I saw, they were down roughly $30. 31.61 right now is the real-time quote. I'm seeing them in after hours, down 31.61. I personally don't own Google. I have some clients that I manage their money that I own Google for them, but I'm not worried about it because I've got it hedged, and I understand how to flow with the market because it's not over, folks. I mean, how confusing is it every day to open up, to turn on CNBC or to open up your web browsers and to see a myriad of different events? Goldman Sachs says the U.S. economy may be fairly bad. Greenspan warns over weaker dollar. El Arian, the big story is that every government policy measure fails. Ken Fisher dubs the new normal idiotic, sees a great decade ahead. Bullish sentiment soars through the roof. This is a graph that represents our current job situation in comparison to all of the other recessions we've gone through since World War II. You see where the job situation is. It's ugly. It still is ugly. As good as news as we've been getting, in fact, that was kind of the news that hurt the market this morning, is what the jobs picture for the week wasn't very good. Oil prices soared a 2-year high on worries over crisis in Libya. Libya halts military action on rebels. Stocks surge on G7 action and sinking oil prices. Japan reaches out to the U.S. in a race against the clock to avert nuclear disaster. Gold prices climb as Portugal may need a bailout. This one's close to home for me. I trade Apple a lot. Apple's jobs call shots from home. How much longer are they going to be able to hold up without Steve Jobs? A major crash is coming for stocks. Commodities are already topping out. Is that how you feel from time to time? Just want to kind of close your eyes and ignore it all, or who do you listen to? It's tough. It is. This market is a very difficult market to trade. I've been trading since I was in college. 15 years ago I started trading for a living. And 15 years ago it was easy. Things have changed. This is a very difficult market to just trade, particularly if you're just trading stock and trying to make it go on what news events move in the market on any given day, who to listen to. Do I trust the Fed? Do I trust Bernanke? Do I trust that Capitol Hill has my best interest at heart? Yeah, these are all tough questions, right? For me, I trust one person. I trust myself. And I look at all these news events and I say I have to trade very cautiously, and I have to trade with the idea that I'm going to have to react to what the market gives me. The reason why OptionsANIMal has helped me, I don't know if any of you in the audience speak Chinese. If you do, you know what that word on the right is. It's a word we've heard quite a few times over the last 2.5, 3 years. The word is crisis. We've had a banking crisis. We've had an economic crisis. We've had all kinds of crises that we've had to deal with. Now, the English word crisis is a very negative word. At least where I grew up it was. I mean, crisis wasn't ever used in any type of positive connotation at all. Very negative word. What I like about the word crisis in Chinese, however, it's made up of 2 words. It's made up of the word danger. The word is weiqi. It's made up of the word danger and opportunity. That is extremely interesting to me, that if you look at crisis, it actually creates enormous opportunity in investing and trading particularly. There are all different types of opportunities in today's market. You have fundamental opportunities out there. Stocks that just make so much money, companies that make so much money that you can go buy them and be comfortable that 10 years down the road you're going to be better. Your stocks are going to be higher based on how much money they're making. There are technical opportunities. These abound daily. Again, this is one of the great reasons what MetaStock can give you is allow you to scan through the market, and based on whatever technical indicator you like to use, to be able to determine here's my opportunity today in this crisis. There are also volatility opportunities. This is understanding how to use options correctly. I'm in a volatility trade right now on Intuitive Surgical that is phenomenal. I don't even have to have the stock move, and I'm going to make money on it. It's great. I can make money in any direction, and most importantly, I can adjust losing trades into winners. Is it easy? No. This isn't a money machine. This isn't, trading in the market, trading and using tools. This is not a money machine. And for those of you who are looking for it, you're not going to find it. But what I will tell you is that there is the ability to make money. There is the ability to protect money so that you can accomplish your financial goals. It requires some time. It requires some due diligence on your part. It requires education. Benjamin Franklin said the only thing more expensive than education is ignorance. Never more true than in the market. Finding a mentor, finding tools that you can use to help educate yourself are imperative to success in the market. Don't go through the school of hard knocks. It's a really expensive one. 1 in maybe 1,000 people will be successful trading going through the school of hard knocks. Now, if you have any questions for me, I can answer a few of them right here if you want to type them in the side in the chat bar. Or let me also give you our website if you'd like to go there, our phone number if you'd like to call in, find out a little bit more about what we are at OptionsANIMal and some of the tools we have, some of the education packages we have, starting from the very basic investor to the very advanced spread trader, and teaching you that adjustment process and how it works. So again, thanks for joining me today in today's webinar. I know there are a few questions I'll get to that have been typed in, and again, feel free to type in any questions, and I'm more than happy to sit and answer questions for you for a little bit. So let's see. Aren't all investments good at the right time? Yes, Joe, they are. They can be. Obviously the problem with that is hindsight is 20/20. So it's easy to look backwards in time and say, oh, this is a good investment, this is a bad investment. What's hard is going forward and saying this is a good time to do this trade. And really the only way you get that type of knowledge is through practical application, practical experience, having been through and done it yourself. Even then, you're never going to be accurate 100% of the time. And even a good strategy like an iron condor, it needs to be adjusted from time to time if you're wrong. Okay. Roland, when do you expect me to have an add-on available through MetaStock? I think MetaStock is waiting on me to sit down with them. So maybe that's something that Jeff and I, the nice thing like Jeff said is, MetaStock, their Equus is based here in Salt Lake City, so I'm actually based just south of Salt Lake City as well. So I probably need to sit down and work with them on developing a potential add-in that I use, some of the signals I use when determining your charts. I don't know enough about how quickly they work to give you a timeline as to when it will be out. But I'll get the ball rolling. Let's put it that way. Because yeah, I think there are some add-ins you can do that can make you more successful. There are technical indicators you can use to make yourself more profitable in trading. Like I said, I shared with you some of my basic ones. If you want to look at just manually combining it on your own chart right now, again, I hope to make it so that it's just an OptionsANIMal add-in so you can just see the buy and sell signals when they come. But for me, it's a combination of those 3 indicators that I mentioned. If I get an RSI crossover through 50, a MACD crossover, a moving average convergence divergence crossover, and if I get a 520 exponential moving average cross and they all occur at the same time, that to me is a very valid signal. Now, of course, it can be a buy signal or a sell signal depending on the direction of the cross. So if they're crossing to the upside, of course, that's a bullish signal. Crossing to the downside, that's a bearish signal. Yes, those are the indicators. So if you want to go test those inside of the platform right now, you can go back and look at it. You know, it's not 100% accurate. It never is. I find this to be much more accurate in very volatile stocks than I do in, say, a stock like Walmart or Procter & Gamble that's not as volatile. It's not going to be as accurate in those because those stocks stay trending more and stay in more of a sideways pattern. But on a stock like Apple or a stock like Nvidia or a stock like Netflix, very accurate indicators that allow you to enter into either bullish or bearish positions. All right, everyone. Any other questions I can answer before I wrap it up? Okay. One of the things I'll also point out to you, we do have another class that you can attend. It's a free class. It gives you a little bit more detail about what we are and what we offer. If you go to OptionsANIMal.com, you'll see a link on there that you can sign up for that free class. You know, come check us out and see what we do and what we have to offer, because I know we'll be able to help you be a better trader and a better prepared for this market that we're in right now. All right, everyone. Thanks again for joining me, and Jeff, thanks for having me. Look forward to doing future events down the road with you and getting rolling on our add-ins. Thanks, everyone. Have a wonderful evening.